Hey, what's going on, guys? It's Dan from Pekoe Mortgages, and we're doing a quick tip today. It's a short video, but I just wanted to talk about interest rates again. I know this has been, it's like we're beating a dead horse right now, but listen, it's so important in today's market that you keep an eye on the interest rates. And if you're thinking of making a move, if you're thinking of taking equity out, if you're thinking of renewing early, now's the time to take a look at those interest rates. When it comes to whether you should do fixed or variable, ultimately that's up to you. But there might be a strategic way of doing this where it helps to hedge against your risk. One of the things that I tell a lot of my clients is in this type of market, we're seeing fixed rate mortgages almost double what we can get for variable rate mortgages. So for example, let's say it's a 3% fixed rate mortgage on a 5-year, we might be able to get 1.5%. That's the spread's about 150 basis points or 1.5% between the two. So it's hard to kind of look at the variable rate and say, oh, there's a lot of uncertainty. We do know that interest rates are likely going to rise this year. What that means is that variable rate mortgage is going to increase as well. It's variable, so it's fixed to the prime rate. And as prime moves up, your interest rate moves up. The good news is, as these rate increases happen, we're going to have to wait a little bit in the economy to see how things shake out. We know that the government's not going to go ahead and just throw out a crazy interest rate and then just say, okay, that's it. We have to deal with inflation. We have to deal with supply chain issues. Logistically, we've got issues going on, convoys, farmers. And when there is uncertainty in a market, the government doesn't want to act too quickly when it comes to interest rates. So we're going to keep those interest rates low, but wait and see. Most economists are predicting at least a 1% increase this year. So what do you do if you're in a situation where you've got a choice between a 3% fixed and a 1.5% variable? It's the devil you know versus the devil you don't know. My advice, go variable. You have a lot of flexibility, way more flexibility than you do in a fixed rate mortgage. Sure, rates may increase, but we're hedging against that rate increase by doing a couple things. Let's say, for example, you're very comfortable with a 3%, just because you know what you're in for. You know what your rate and what your mortgage payment is going to be every month. That's fine. Set up that payment as if it was set at 3%. But let's get you that 1.5% mortgage, right? So every month you make that payment as if it's 3%. That additional money is going directly on the principal balance. So you're actually accelerating your pay down and your payback of that mortgage. It'll reduce your amortization, and it's kind of like self-insuring. So anyone out there that's a pet owner, you may have been faced with the option of getting pet insurance. Most of the time, people will self-insure. So you put a little bit of money in the bank in case your pet needs some medical attention from the vet. In this case, we're doing essentially the same thing. We're taking some of the money to offset any increases in the future we may be experiencing. And in the meantime, you're reaping the benefit of it going directly on your principal. Anyway, that's what I got today, guys. Just a quick tip. Again, thanks again for watching. Comment, subscribe, like, and I'll see you around shortly. Take care.